So, the matching principle of accounting, or the matching concept, is that expenses should be matched to the same accounting time period as the revenue that was earned as a result of incurring those expenses. So, in other words, we're going to subtract the period's expenses from the period's revenue. And you and I do that usually with our checkbook on a monthly basis. We take what we owe out of the money we bring in, right? So, adjusting entries are needed to properly match expenses and revenues. And adjusting entries can be made at any time, but they're normally adjusted at the end of the month or the end of the year. So the next thing we're going to look at is the worksheet. And that's just an informal working paper prepared for the purpose of organizing data and to help us in the preparation of our financial statements. So smaller companies may not even do a worksheet, but larger companies have hundreds of accounts and dozens of adjustments, and it's a tool, although optional, that helps them get easy completion at the end of their accounting cycle. Now, in practice today, worksheets are rarely done by hand. They're done using electronic spreadsheet software like Excel, but the objective is the same. So you see here, it's used to organize data, lessen the possibility of overlooking an adjustment, provide a math check, and arrange data in logical form for our financial statements. Our steps in completing the worksheet: we enter the heading, the current trial balance, the adjustments in the debit and credit columns, and then we complete our adjusted trial balance columns. Then we complete the income statement columns, the balance sheet columns, and then we're going to total the income statement and balance sheet columns, and then determine the amount of net income or net loss and balance our statement columns. For the placement of items on a worksheet, here is an example, and this is on page 146 in your book, and you notice you have some clear pages beside that. If you'll flip all the pages up, it shows you the completed worksheet, and if you want to look at it one at a time, overlay 1, 2, 3, and 4, each one will show you the different steps in the process of creating a worksheet. Before we move on to preparing financial statements, one last thing about our worksheet. In the balance sheet columns, we list the owner's drawing account. Now, the owner's drawing account is part of owner's equity, and it's reported on the statement of owner's equity. So that might confuse you, but we do this for a simple reason. We do it to keep from creating another set of columns just for the balance of the drawing account. So, instead, we show the balance of the drawing account in the opposite column, which would be the debit column, of where the owner's capital account balance is extended, which is the credit column. And that creates an offsetting effect and saves the additional set of columns for just one amount.